All right, so tonight we get to finally start looking at derivative securities. So we'll start with forward and futures contracts. And I think I mentioned this yesterday. This topic is maybe a little bit less mathematical than some of the others, but it's important to understand how these products work and how they're used for hedging purposes, because that's really what they're meant for. Derivatives are ultimately designed for hedging, which means they're designed to help us reduce risk. Okay, so they're very popular with multinational corporations and banks and anybody who does any kind of business where they may have to buy and sell assets in the future. Then the thing they're worried about is prices fluctuating. And so forward contracts and futures contracts can be used to help lock in the price at which they can sell something in the future or buy something in the future. So the amount of trading in these products is actually quite massive. And then a lot of the concepts that we'll see here apply to other derivatives as well. But when we're done with this chapter, we'll be diving into options, which are by far the most complicated derivatives. And so that's where we'll spend most of the rest of the course, understanding the properties of options and understanding how they're priced, because that really is one of the most challenging features of the derivatives markets, trying to price options, especially because many of them are actually insanely complicated. There's all kinds of products out there, and we'll discuss that when we get there. But forward contracts are a very straightforward idea. It's simply an agreement between two counterparties, which they agree in the future to buy or sell an asset at a price that's settled on today. So it's like, imagine yourself making a deal to sell your car to your brother-in-law in 1 year at a price of $10,000. That would be an example of a forward contract. The reason why it's called a forward contract is because the transaction will not take place until the future, but the price is settled on today. So forward contracts have many advantages. Among them is complete flexibility, because the reality is, two counterparties can agree to almost anything you can imagine. And so imagine a multinational corporation that deals in a country that, let's just say it's a relatively small country like Iceland, let's say. A US company does a lot of business in Iceland. Now, Iceland's currency, the kroner, is not heavily traded in world markets. So if I want to hedge the risk that the kroner will fluctuate in the future, it's not going to be difficult for me to go out and find an Icelandic bank or some other Scandinavian bank that will enter into an agreement with me to buy or sell kroner in the future at a predetermined price. So even for markets that are not terribly liquid, it's easy to arrange a forward contract to do something in the future. So, by the way, here's some important terminology. When we enter into a contract, clearly there's a buyer and there's a seller. Whoever is agreeing to buy is said to have a long position or a long forward position. And whoever agrees to sell is the one with the short position or the short forward position. Okay. So there's always a long and there's always a short. The two counterparties agree and we have a contract. Okay, by the way, more terminology here. An asset that is going to be delivered today. Let's say that we look in the Wall Street Journal and we see that gold is currently selling for $1,800 an ounce. Because that price is something that we would pay to take immediate delivery of the gold, that is referred to as a spot price. But if I enter into a contract with a counterparty to buy gold in 6 months at a price of, let's say, $1,750, that is a forward price because that transaction will not take place until the future. Okay, so spot means the price paid for immediate delivery of an asset. I need the gold now. What's the price? I pay it, I take my gold. That's the spot price. The forward price means I don't need the gold just yet. How much will you agree to sell it to me for in the future? So this is the price paid for future delivery. Now, the thing is about a forward contract is we can agree to any point in the future, although these contracts tend not to go out much beyond a year because there's so much uncertainty associated with things that will happen more than a year in the future. So you might see a contract for 3 month delivery or 6 month or 9 month, whatever the case may be, but we can choose any dates we want. Okay, everything can be customized the way we like it. Now, our first equation. So what we're going to do is assume that the spot price of our asset is S. That's the price for immediate delivery. Okay, now R, we'll see this a lot as we go along with these derivatives models. R is the risk-free rate of interest. Now, what does that mean? Well, T, by the way, is the time, usually measured in years. And so, in other words, what's happening here is we're assuming that the asset that we're buying through a forward contract will be delivered at time T. So basically, what's happening here is that let's say T is 3 months. So then the risk-free rate, R, would be the 3 month Treasury bill yield. Okay, now as we know, the Treasury market is where these different bonds trade issued by the Treasury Department of the US government for the purpose of raising money to pay for its debts, which it always has. It's always overwhelmed with debts and they're always borrowing money. So these bonds are a way of raising money to cover their shortfalls. I mean, they clearly are spending way more than they bring in taxes. So the only way they can cover their debts is to borrow money. And that's how they do this. Okay, it's like it's as if the government had a gigantic credit card and it just kept paying it everything with a credit card. But from our perspective as investors, these treasury securities are guaranteed to be paid when promised. The government will always find the money it needs to pay back its debts. It's not like a corporation that can go out of business. If the U.S. government is running out of money to pay off all the bonds that it's issued, they have other options like raising taxes, for example, which a corporation doesn't have. So these are considered to be risk-free securities. And when we say risk-free, we mean free of credit risk. Okay, they do face other types of risk, but they're free of credit risk. And so the yields on these securities are referred to as the risk-free rates of interest. So if, for example, let's say the yield on this is 4%, that would be defined as the 3 month risk-free rate. And then F is the forward price, or what I should say, it's the T period or T year forward price. Okay, so in other words, if T is 3 months, a quarter of a year, F would be the 3 month forward price of this asset. And interestingly enough, all this means, oh, of course, E, yes. E is a constant you've encountered in calculus. It's approximately 2.71828. And if you recall, it is defined very simply. There's a couple of alternative definitions. Okay. And if e to the, let's say the R power, this one would be replaced with an R. Okay. So basically, This is what we mean by, as we saw earlier in the course, this is the R in this case would be the continuously compounded rate of interest. So I did mention this once before. With the derivatives markets, we tend to use continuously compounded rates because of there's several reasons why it's easier to deal with risk-free continuously compounded rates. So we'll see that throughout the course. And in Hull's book in particular, he almost never uses discretely compounded rates, even when he really probably should. Continuously compounded rates are always used in the derivatives markets. So ultimately, then, what this formula is telling me is that F is the future value of S. That's all it is. It's the future value of S. Okay. So it's a very mysterious looking formula. Now, of course, assuming that the risk-free rate is continuously compounded. Wow, that seems too easy, right? Now, here we're going to introduce a very important idea. And this is going to be something we'll see throughout all the derivatives markets. This notion of arbitrage. Now, you may have heard this word before. And in fact, it used to be a common thing for people on Wall Street. There used to always be some of these arbitrageurs, they were sometimes called. Some of them were quite infamous, as a matter of fact. And basically, what happens here is that an arbitrage takes place when the risk-free profit it can be earned um, by simultaneously buying a relatively underpriced asset, selling a relatively overpriced asset. And what's important about this is that it can be financed with borrowing. So in other words, if you're a trader at a major investment bank, and this is your job, what you're looking is for is opportunities where you can borrow money and finance a position in a cheap asset, an asset that's too cheap, and then sell that asset at a higher price, possibly in a different market or at a different point in time. But the important thing is that you're taking this position where you're making money where technically you shouldn't be able to, because arbitrage opportunities can only arise if prices are incorrect or inconsistent with each other. So that arbitrage profits can only be earned if markets are inefficient. So we're going to call it inefficient. In other words, prices are inconsistent with each other. All right, well, let me just show you a quick, simple example of when this might happen. And now keep in mind, at this point in time, you're not going to run into this very often, if ever. Markets are really efficient. Computers are keeping track of information. They're doing a lot of the buying and selling. So imagine that the exchange rate between the US dollar and the British pound is $2. Let's just make it simple, $2 per pound. I know it's nowhere near now, but okay. And then we find out that there's a gold dealer in New York. Gold is selling for, say, 1,800 per ounce. And then we find another dealer in London for 800 pounds per ounce. Okay, now you might say, well, what's the big deal? Well, clearly, the London price when expressed in dollars, is 800 pounds per ounce times $2 per pound, which works out to $1,600. So what's going on here? The gold seems to be cheaper in London than in New York. So you might say, well, so what? Well, it's a big deal because look what you could do now. Now, I'm assuming again, you have the ability to buy and sell this asset. You're a dealer in this market, or you work for an investment bank or whatever. An individual might not be able to pull this off, but if you're working as a trader for one of the major investment banks, um, a trader could borrow or use the bank's money, eight $1,600, buy 1 ounce of gold in London, or 1,600, sell the gold in New York for 1,800, repay the loan. Now, this would take place almost instantaneously. Now, by the way, at this point in time, these transactions will almost certainly be made by computers. The markets change so rapidly that by the time a human being noticed this, the opportunity would be gone. Okay, because here's what's going to happen. This trader just earned a $200 arbitrage profit without taking any risks. There was no risk involved here. The trader has earned a $200 arbitrage profit. Now, here's the thing though. Other traders will notice this. They will all want to buy gold in London and sell gold in New York. This will cause the price to rise in London and fall in New York. As a result, prices will equalize very quickly. Now, that in the past, imagine this is the 1970s and all your information is coming from the telephone. There's no computers, or at least they're very, very slow. And how do you know that these prices are what they are? You're on the phone all day with other traders and brokers in other countries. So there's a time lag, and it could take a while before people notice that there's a discrepancy here that can be taken advantage of. So arbitrage profits were much easier to find back in the day before computers got involved. Now what's happening is that you've got all these hedge funds. You have enormous banks of computers sifting through tons of market data all around the clock. And as soon as they notice something like this, they are able to go in and actually execute these trades themselves because they may only last for fractions of a second. So if there's any arbitrage taking place, it's most certainly between computers trading with each other to take advantage of extremely short-lived discrepancies in market prices. So it's still possible for arbitrage to take place, but it's highly unlikely that individuals can take advantage of this. But because of this, what this does is it ensures the fact that traders profit from temporary discrepancies, ensures that prices will rarely deviate from their correct, I guess we'll call it, values. In other words, values consistent with other market prices. So in other words, markets are incredibly efficient at this point in time. So arbitrage doesn't pop up very often, but because of that, it means that these prices don't usually deviate, rarely, if ever. So this equation that we just saw, if it's violated, meaning that if we could find a discrepancy, we could earn arbitrage profits from this relationship as well. Okay. So in other words, if this relationship is violated, then arbitrage profits. Oh my God. And so as a result, in the process of exploiting these arbitrage opportunities, um, the prices will adjust to the level at which this equation is satisfied. Very, very quickly. So because of that, we often call this type of relationship a no arbitrage relationship, meaning that if this relationship fails to hold in the real world, arbitrage will take place and the prices will suddenly line up again with each other. So the basic logic is always the same. Suppose, for example, we discover that F is too high to be consistent with this relationship. What would you do? So remember, what's happening on the left, this implies that this number, which is the forward contract, by the way, this is overpriced or too expensive, and this is underpriced. So we always buy whatever's underpriced. So we're going to borrow S dollars, buy the asset, okay? And then we're going to take a short forward position, meaning we're entering into a contract to sell the asset at price F. And by the way, when we borrow S dollars, we're going to assume that we will repay SE to the RT dollars. That's the cost of borrowing this money. Now, here's the thing. F, by assumption, is greater than SE to the RT. So that means that we'll collect F dollars and we repay SE to the RT dollars, and that means we're making money. So this means that the difference between the two is positive, and that puts money in our pockets. Okay. So in other words, by borrowing the S, repaying SE to the RT, buying the asset and agreeing to sell it for F, we just put money in our pocket without taking any risks. By the way, that's the reason why this R is here, because it's a risk-free proposition. The rate of return just in the most general possible terms, the rate of return to a risk-free transaction is the risk-free rate of interest. What would happen if not? If you could earn more than the risk-free rate of interest, then that would lead to arbitrage opportunities, okay? Because you would borrow at the risk-free rate and engage in this transaction and earn a higher rate of return, and you would make guaranteed money. So in other words, throughout all of these derivatives models, we'll see the same thing. If the transaction is risk-free, then the rate of return has to be that R. Otherwise, it'll be an arbitrage opportunity. Now, what if we have the opposite scenario? And yes, by the way, here's the explanation. When the contract matures, we deliver the asset and receive F, and then we repay the loan. Fine. But remember, we're assuming that F is greater than SE to the RT. So the amount that we collect is greater than the amount that we repay. Now, what about here, the opposite? Well, now this is the one that's underpriced. And this is the one that's overpriced. And that means we have to buy this and sell this. Sell means take a short position. So in other words, this is a transaction that you might not be familiar with, a short sale. A short sale, let me just explain this a little bit more in the next slide. With a short sell, the investor borrows the asset, borrows an asset with a promise to return it in the future, probably with interest. So what happens then, now why does anybody do this? What's the point? So the investor hopes to buy, to reap, oh, I almost forgot. The investor borrows the asset with a promise to return in the future with interest. The investor then sells it and hopes to buy it back for a lower price and then return it to the original owner. Okay. So in other words, imagine, I'm pretty sure that Apple stock is about to have a rough week. So I call up my broker and say, listen, I want to borrow 100 shares of Apple, and they're currently selling for 200, and I'll pay them back next week with $10 worth of interest. So what I'm hoping to do is sell them at 200 and buy them back for, let's say, 150, and then I return them to the broker along with some interest, and I've made a nice little profit. So I'm basically betting that the asset price will go down. So this is not an easy thing to carry out. It's not something that everybody is allowed to do. There's a lot of restrictions on it. You have to put up collateral typically. There could be other fees involved. It's a very risky thing to do. But it's certainly possible, especially if you're like a trader, like I said, at a major investment bank. You certainly would have no trouble doing this. So that's what's happening here. We're short selling this S, hoping that it will go down. Or actually, in this case, we don't care because we've locked in the ability to buy it back for price F. So we're selling it for S, and then we're guaranteed to be able to buy it back for F through this forward contract because we're taking a long position in the forward contract. So in other words, unlike here, where we have to hopes to buy it back for a lower price, here it's guaranteed. We know we can buy it back for F because we're entering into a contract to do exactly that. Wow. So this is going to leave us with an arbitrage profit. And again, like before, if that's the case, if I can make arbitrage profits, everyone else will do the same thing. And then the prices will adjust until they're equal to each other again. So of course, what this implies is that if F being above SE to the RT leads to arbitrage, and F being less than SE to the RT, the only way we can avoid arbitrage is if the two sides are exactly equal to each other. So that's why we call this an arbitrage-free relationship, because it can't be violated without leading to arbitrage profits. And if they do have profits like that, the relationship will correct itself very quickly. Now, by the way, this discussion we just had is based on the assumption that the asset underlying this contract does not provide any type of cash flows to the owner. Okay, let me just mention that here. So this relationship, this formula I just showed you is correct, but only So in other words, imagine it's a bar of gold or something like that. For example, gold provides no income to the owner, so it can priced with this equation. Okay, in other words, you don't get any interest payments, you don't get any dividends, anything along those lines. But what about assets that do provide income? And there are many of them. For example, what if let me show you a quick example in the next slide. Suppose that the spot asset S is a British pound bank deposit. Okay. So in other words, let's say I'm an American company and I have an account with Barclays in London and I've deposited 1 million British pounds. Well, I'm going to be paid the British rate of interest, not the American rate because they're pounds. I'll be paid the British rate of interest, whatever that happens to be. And so the owner of this deposit is earning the British rate of interest, the British pound rate of interest, whatever it happens to be. And by the way, this type of thing is meant to be it's thought to be risk-free. We're earning these interest rates in a very special market. In fact, we'll need a little detour for this too. The rate of interest that is being earned is coming from the euro currency market, which is not exactly risk-free, but very close to it. So the euro currency market is where currencies are held outside the country of origin. For example, suppose that a US multinational holds dollars in a French bank. Now, normally if you have money in a French bank, you're going to keep them in euros. But this is a multinational and they need both euros and dollars in their daily operations. So they can go to a large French bank, Societe Generale, let's say, and they can say, listen, we want to keep dollars on deposit here because we may need them, or we may be receiving payments in dollars, or we may be making payments in dollars. So what will happen is the corporation is earning the euro rate of interest. I'm sorry, the euro dollar, it's called rate of interest, not the French rate of interest. So in other words, the interest you earn depends on what currency you're holding, not the country that it's in, but the currency itself. So the French interest rate may be below this and maybe above it, but because you're holding dollars in this bank, you're being paid the so-called euro dollar rate of interest, where the prefix euro here means outside the country of origin. Okay, now all of this got started way before the euro currency was introduced, so there's some potential confusion there. This market actually came about in the 50s. What happened was, interestingly enough, when Stalin was still alive, he was always worried that, all the money, communist dictators have a very bad habit of stealing a lot of money from their citizens and salting it away in secret bank accounts. And Stalin was no exception. He could do whatever he wanted. So he had a lot of dollar deposits in the United States in American banks because he knew that if he was ever overthrown, he could escape and still always have access to his money in American banks. So every so often he would pull some stunt or other, and he would be worried that America would seize his assets. So what he did was he was able to negotiate um, the deposit of these funds in a British bank that was willing to pay. I don't remember all the exact details, but he was able to keep his money in London without holding it in the form of rubles, which are essentially worthless. And so he was keeping, but it wasn't pounds, it was probably dollars. So in other words, he moved his dollars out of American banks into British banks, but he continued to earn the US rate of interest. So those deposits became the first euro currencies. And the market, once people saw what happened, it became clear that this is a very important development. A lot of investors, a lot of multinational corporations might want to do the same thing. So the market grew like crazy. And it's a huge market now because once somebody comes up with an idea like this, it often catches on very quickly, and before you know it, it's a massive market where you can keep currencies wherever you want, basically. I can keep dollars in basically any country in the world and continue to earn the US rate of interest, although this activity tends to be restricted to the major Western European countries and Japan. But like I can keep dollars in Switzerland, and then they were known as euro dollars, and I will be paid whatever rate of interest is appropriate for dollars rather than Swiss francs. So in this model I'm about to show you, this example, the risk-free rate of interest is actually a euro dollar rate. Okay. It's not technically risk-free, but it's awfully, awfully close. So what's happening here is that I'm assuming that I own a foreign currency. Let's see where. Okay, here we go. Here we go. This is what I was looking for. Now, the interest that I earn on a bank deposit, no matter where it's located, typically the normal convention is that interest rates paid by banks are typically compounded daily. The difference, as if you want to do some numerical examples, you can. The difference between the interest paid when compounding is daily versus continuous is extremely small. Okay, in other words, in many cases you wouldn't even notice the difference because you're rounding to dollars and cents. So the difference between daily and continuous compounding is not going to be a very large amount. So what we can do here is fudge our model just a little bit and assume that if we own, let's say, British pounds, we have British pounds deposited in a foreign bank of some kind, we can count the interest rate we're earning as a continuously compounded yield, which we'll call Q. Okay, so if this is happening, that means we have to take this into account in this formula, because here's the thing. If I keep my funds in a foreign bank, I can earn a rate of interest. But if I hold a forward contract, I'm not earning that rate of interest. So the fact that I'm losing that opportunity is reflected in this equation where, if you notice, I'm subtracting Q, which reduces the value of my position. Okay, so if the asset, let's say this is a forward contract in British pounds. Or what I should say is the forward price of British pounds. That is going to be less attractive than actually owning the pounds in the sense that I'm not earning the British rate of interest. So that's why the model has to be adjusted to show that this position is less valuable than the position I had with gold, because with the gold, I'm not giving up the opportunity to earn any interest or anything like that. But here I am. So that's why that Q is there. And it could be anything. It could be any kind of cash flow that I might earn from this asset S. So that's why we have that Q there. And once again, this is a no arbitrage relationship. Meaning that if it's violated, there will be an arbitrage opportunity. It'll be a little bit more complicated, but it's the same principle. And that for that reason, this will usually hold in practice, this relationship. By the way, when this specifically refers to currencies, this formula has a special name. So remember, this applies to any case where the asset provides a cash flow. But if it does specifically refer to a currency, then this formula has its own special name. If the asset S is a currency, then this relationship is known as interest rate parity. I just thought you'd find that interesting. So in other words, that's the specific case where S is a foreign currency. But it applies to all cases where the asset provides some kind of a cash flow to the owner. All right. Now, with forward contracts, the price at which you agree to buy or sell is often referred to as the delivery price. Okay. So in other words, if I enter into a contract to buy gold at $1,800 an ounce in 6 months, that is known as the delivery price. Now, this is important because that is fixed. It never changes. But the forward price can fluctuate every single day. Okay, in other words, if you have, let's say in this case, if S changes, R changes, or T changes, well, T, of course, changes a little bit every day. We probably shouldn't think about T so much. It's really the other two that can fluctuate. We know that time passes. That's the only way that that can change. But if S or T, or R rather, well, then F changes too. So in other words, let's just say that I agreed to buy gold for $1,800 an ounce. Fine. Like here's a general discussion about this. So that means that, let's say if I agree to buy gold in 6 months for 1,800. By the way, we're going to call this X. This is Hull's notation. Fine. But if, let's just say that the spot price of gold rises, your position has gotten stronger. Okay, so in other words, let's say that when I entered into this contract, the forward price and the spot price were both 1,800. Suddenly the spot price of gold goes up. My contract is actually worth more than it was yesterday because I have the ability to buy gold for 1,800 when it's worth 1,900. So F has to increase So since S increases, F also increases. Now it could go both ways. Now, by the way, if you're planning on taking delivery of this gold, I mean, this doesn't really affect you in any way because you're still going to take delivery at that price, but the value of the contract can fluctuate. And if for some reason you need to unwind this contract by agreeing to terminate the whole thing, you may find yourself having to pay money to the counterparty for them to agree to it. If your position is losing money, you may have to pay to get out of this position. So what would this introduces is the concept of the value of the contract. On the day that we enter into a forward contract, um, whatever that day is, a contract is entered into, the value is zero to both counterparties. Okay. We both have a contract in our hands which has no value because we're agreeing to buy something at the correct price. Um, After that, every day after this, the value of the contract fluctuate, but the gains of one side, one counterpart, exactly offset the losses of the other counterparty. So in other words, you can't both win and you can't both lose. Whatever one side gains, the other has to lose, and vice versa. So the total value of the two positions is always zero, but each one individually can have a different value. So here's the formula we can use to derive this. Now we're introducing lowercase f now to distinguish the two. This is the forward price. This is the delivery price, which is never going to change. And this is the actual value of the forward contract to the long position. Okay. You notice how it says long. I'm the buyer. And so you can see just by looking at this, if F rises, then so does lowercase f. I profit from it. But of course, if F goes down for some reason, I'm going to have a weaker position. F falls. Okay. And then we reverse this for the short position. And if you notice, the two of them add up to zero, no matter what. Okay. In other words, these two add up to zero. And of course they do. Sorry, that's minus F. And you can see these all cancel each other out. Zero equals zero. Okay. Now, by the way, this is important for its own sake, but later on we'll see how this in this is the foundation for what comes with options. We're going to see options have some similarities with forward contracts, but some very important differences. So when we start looking at options, we'll be able to come back and revisit this discussion and see how options are different. So assuming then, so again, if you're the long and you have an asset that pays no income, you can see what we can do now. We can derive a pricing formula for this forward contract. you're replacing the F with SE to the RT, and this is your final result. And again, you'll see when we get to option pricing theory how important this is. So for the long, this is the value of the contract. For the short, one more thing, I forgot to mention this. When you look at these, notice here, what this tells me is that F is the present value of F minus X. Now, the reason why it's the present value is because this transaction won't take place until the future. Okay. So the formula is basically saying that this is the present value of your position. If F is greater than X, that means you're making money. Otherwise, you're losing money. All right. Here's a quick example. A 6-month forward contract is entered into with a delivery price of $11.20 per ounce. Oh, I think I forgot to mention that this is gold. Oops. Okay. And then a month later, the forward price is going up to 11.30. Now that means the long position is making money. Let's find out what the position's values are. Okay. Now, by the way, if you notice, a month has elapsed. So therefore, in 1 month, if you notice, in 1 month, T will be 5 months or 5/12 of a year. Okay, so that's something you have to pay attention to. In a month, there'll be only 5 months until the asset is delivered. So the T has to be changed to 5/12. The interest rate, we're assuming it stayed at 5%. And you can see by plugging these in, the long has a position worth 979. The short, not obviously negative 979. Now, what this means is that if the short wants to get out of this position, which, it's possible, they may have changed their minds, they don't want to do this. There's no legal obligation for either side to unwind this position, but that would mean that the short would expect to pay $9.79 to the long position in order to unwind this position. It's not impossible, but it's not easy. There's going to need to be some money changing hands because this long position is more valuable since it has gained 979 since day one. Okay. Oh my God. Now, so with all that being said, what's coming up next is a discussion about hedging. So we need to understand what hedging is because, again, derivatives ultimately were designed for hedging purposes. We want to figure out how to use them to reduce our risk. And you can see with forward contracts, it's pretty straightforward because they're locking in a price now at which you can either buy or sell in the future. And so that's why these are so popular because they're so flexible. You can customize them to anything you need. So we're going to turn our attention back to the foreign exchange market, where there's a lot of forward contracts being used every single day. And so once that's done, we'll have a quick example about foreign exchange forward contracts. Then we're going to turn our attention to futures contracts. Now, futures contracts are very similar to forward contracts, but there's some very important differences. The logic is the same. We're trying to lock in the price for future delivery of an asset, but it has certain benefits and certain drawbacks that you don't get with the forward market, with forward contracts. So for some investors, futures contracts make the most sense. For some investors, forward markets make the most sense. That's why both markets continue to exist because there's enough demand for both products. As a matter of fact, over the years, many derivatives have disappeared because of lack of interest. It's like any other market. If people aren't interested, the market disappears or closes down. So as far as this is concerned, what I would like you to really see is that because there's so much trading going on in this market, if you looked in, let's say, the Wall Street Journal, what you could find is, and this is a very old example when the pound was worth a lot more, but the logic is the same. Look at these numbers. This tells me that if I want to buy a single British pound today for immediate delivery, it'll cost me 206.83. But if I don't need to take delivery for a month, I only have to pay 206.62. Um, 3 months it's 206.22, and 6 months is this price. And this reflects the formula we were just looking at earlier. That's where these are coming from. Given the spot exchange rate, the rest of these are being driven between by the differences in the risk-free rates in the two countries. That's it. That's the only thing that, and the time as well. That's what's driving this. And remember, these are no arbitrage relationships. So if you can find a dealer who gives you a different quote, you want to go to them because you can probably make money at their expense. Okay. So anyway, all right, I'll tell you what, why don't we knock it off right here? Next time we'll wrap it up this chapter with our discussion about futures and see how the two types are different. And then at long last, we can introduce options. Okay. And you'll see that options are basically in a lot of ways like forward contracts where you have additional rights that you don't have with forward contracts. And you can see that makes them a lot more powerful, but it also means that we have to pay for them. Okay. A forward contract, you don't pay for it. You're just entering into an agreement. But with an option, you have to pay for it, whether you use it or not, just like insurance. Okay. So, all right. So we'll stop right here. I think that's enough for now. And then we'll carry on next time with our discussion about futures contracts and how the two are different from each other. All right. So I'll see you next time.